Today, we welcome Lance Lambert back. He's the co-founder of Resiclub, a housing analytics company. And Lance is a monthly contributor to our podcast. His links are below in the show notes. And he has a great email that you could sign up for and growing. I mean, his X account seems to be growing every single day. Everybody's interested in what he has to say. But today, he's providing us with a real-time look at what the current data is telling us about the U.S. housing market. And Lance is about to share with us price trends, inventory levels, and what home builders are saying, and so much more. So we'll dive in. Lance, welcome back to the show.
Housing. Thank you so much for having me back. And there is always so much happening in the housing market, especially right now.
This show is brought to you by Sachs Realty Education. Here you can find my Todd Simple Home Buying course. It's self-paced, packed with insider secrets, teaching home buyers how to save potentially tens of thousands of dollars when buying a home and how to avoid costly mistakes. You'll get worksheets, sample contracts, resource guides, and more. The link is pinned in the comments below. Yeah, did you have any idea when you started Resiclub that you were going to be right in prime time for keeping us updated here? I mean, you are definitely in high demand. I see you in the news, and everybody is. I mean, it's crazy. I'm glad that we have you on our show, but everybody wants your information. They're sharing your charts. I see you all over the place, and LinkedIn and X and you name it. So excited to hear.
I think a lot of that comes down to the fact that just, housing's such a big part of people's lives, right? It's such a big part of their expense. It's a lot of, it's a big part of even their personal wealth. And people want to figure out what's going on. And you look at stocks, and Monday through Friday, 9 to 5, you know exactly what the 7,000 plus stocks listed on the New York stock or the stock exchanges in the US, you know the value of those, right? You know exactly. With housing, you don't, right? And there's not just 7,000 homes in the US, there's 100 million plus units, right, of housing in the United States. And at any given time, there's so much nuance to all of that. And so I think people want a lot of good information. And it's just kind of hard for people to figure out what's going on at any given moment.
That coupled with the fact that it's so backward looking, right? It takes, 30 to 45, 60 days sometimes before we can get the information of what someone has even paid for the house until it closes. Well, let's dive in. Let's tell us, are home prices still correcting?
Yeah. So what we're seeing in the U.S. is essentially for the past 3 years, this market is still going through a process of recalibration, a process of normalizing, a process of correction, whatever word you want to use. And it really all boils down to the fact that during the pandemic housing boom, there was too much housing demand all at once. There was a pull forward of housing demand to that late 2020, 2021, early 2022. And it came through many different forms. The ultra low rates really made a lot of properties cash flow, right? A lot of investors piled in. There was a big increase initially in short-term rental demand. And so those rates went up a lot. And so it spurred a lot of interest for investors to buy properties to make them Airbnbs. The capital markets back in 2020, late 2020 into 2022 or 21 are humming, right? The Fed had bought up a ton of treasuries and mortgage-backed securities. That pushed a lot of money that was printed into the capital markets. It had to deploy somewhere. So also the institutional deployment into build-to-rent, single-family rentals went up. And then you look at things like work-from-home arbitrage, where people could take their higher income in a New York City, Los Angeles, Seattle, and go buy in a place that they considered more affordable to them, a Nashville, a Boise, a Tampa, a Jacksonville, and Austin. And then even the people who stayed in a lot of these markets, there was an increase of 1 million plus household formations because people wanted more space. They had a roommate that they're used to seeing 3 hours a day. Then during lockdowns, they're seeing them 16 hours a day. And they're like, you know what? I hate your guts. And then people wanted more offices and all of that. So during that pandemic period, there's this huge increase in housing demand. The Federal Reserve estimates that for the market to absorb that big jump up in demand, that new home construction housing starts would have needed to increase 300%. That's not possible. You can't increase it even 50% because there's real constraints in terms of the number of people who know how to do all those things that go into building a home, the labor market for it. There's constraints in terms of the supply chain for lumber, windows, all of that. And then, of course, there's only so much entitled land that is ready. So, housing in general, the supply, the actual home stock in the US is not very elastic. And so, where you get into trouble with housing is that the demand side is very elastic. And so it creates these kind of boom bust cycles in housing. And that's what we saw is a big jump up in demand during the pandemic. We couldn't absorb it because that's just not how housing works. And so we saw a huge overheating for prices. And we went up 45% on a national basis within 18 months during the pandemic. We almost saw a decade of home price appreciation within just 18 months on a nationally aggregated basis. And so coming out of that, that's still where we are now, is the market is still coming out of that. And what we have been seeing this year is that there's been a bit of an acceleration in the softening that's occurred. And so the supply demand equilibrium is shifting more and more in the direction of buyers as that active inventory begins to rise, right? So think of it as like the demand part, you know, that pulled way back right away in mid 2022 when rates shot way up, right? But slowly that active inventory is rising because of that suppressed level or that low level of housing demand, and so that supply is building up. And as that occurs, that equilibrium is shifting to buyers, and so more of the markets are seeing outright falling declines for home prices. And so in January, there was 31 of the nation's 300 largest markets that were seeing falling home prices. The next month that went up to 40, then it went to 60. And then these past couple months we were 110 and now we came down just a little to 105. But still that's 1/3 of the nation's 300 largest metro area markets. But one thing to keep in mind is that a lot of these small metros are in the Northeast and Midwest, right? The places like, the Akrons, the Youngstowns, those smaller MSAs. And so if you just look at the 50 largest metros, half of them are seeing outright declines, 50%. And on a national basis, if you look at these different indices and you look at them without seasonal adjustment, there was a little bit of appreciation. But if you seasonally adjust it, Case-Shiller is actually down for the year. FHFA is actually down for the year on a seasonally adjusted basis. And so what those models are telling us is that the models believe, based on the trajectory of prices in the first 6-7 months of the year, that as we move through the seasonal low period and we perform worse than the seasonal low period is used to, that we will actually end with a negative level. Prices will have fallen on a nationally aggregated basis for the year. That's what the FHFA and Case-Shiller models believe based on the current trajectory. And so if that were to occur, this would be 2025 would be the first year for an annual outright nationally aggregated home price decline since 2011. You had it in 7, you had it in 8, you had it in 9, you had it in 10, you had it in 11. And so we haven't had a negative outright nationally aggregated year since 2011. Now, where we end up for a lot of these indices, some of them might end up being slightly positive, some of them slightly negative. The big picture, though, is that we've seen this softening. Since the mortgage rate shock, every year we've been softening more and more. And that's really the theme of this year, was a greater softening. Active listings moved up more, and we saw more of these markets see outright declines. And so if you want to know the things that correlate with the declines, I could show some of those. So back in 2022, I did an analysis for Fortune magazine because the housing market at that point, we had been through the pandemic housing boom. It was pretty obvious to people who weren't in denial that we were going to see a pretty big mortgage rate shock, and it was going to fizzle out a pandemic housing boom. You can't stay in a housing boom like that forever. And so I was trying to look at the things that I thought would correlate or, potentially be flags for downside risk in the market. And I talked to Mark Zandy over at Moody's, and he provided me their overvaluation score that they do quarterly for 400 metros. And I took that and I published the results. And what the results found is that Austin and Boise, of the 100 largest markets, have the highest level of overvaluation. They were followed by kind of places like Cape Coral and Nashville. And 3 years later, so this month, I took this data that I got 3 years ago, a little more than 3 years ago from Moody's, and I looked at how it compared to how prices have shifted since each market's individual 2022 peak. And what I found is that there is very much a statistical correlation, and that the markets that are that had a greater overvaluation in 2022 are more likely to have seen prices give up since their 2022 peak. And so the theory going back 3+ years to when I published the data is that the markets that were most overvalued, and overvalued doesn't necessarily mean that prices have to fall X percent, right? Just as, when they're undervalued by X percent doesn't mean they have to rise X percent. But what it means is that's the deviation from where prices are given to how they've historically tracked relative to incomes, right? And so if a market like in Austin becomes overvalued by 55% or 65% or 70% like it was in spring 2022, that means that Austin home prices in Q2 2022 were 70% higher than how they had historically been relative to incomes in that market, if that makes sense. And so when you have a greater overvaluation, you have a greater risk of a bigger negative demand shock. Because what occurs is when you get further away from your local incomes and where you've historically traded for your market, then what can happen is more people are just completely priced out of the market. And if you're relying on more like domestic migration into the market, like Austin was in 21, 22, and then that tapers off, like we've seen, then you have to rely even more on your local incomes, and you're even further away because you're more overvalued. And so it creates that greater negative demand shock. And then the places that were less undervalued, the places like Hartford and Syracuse and Chicago and New York's Metro MSA, those have been the places that have performed better relative to the national aggregate since the mortgage rate shock occurred. Now, what are some of the other things? Well, some of the things that correlate even stronger here are multifamily supply and single family supply. And so the reason for that most likely is that for the single family supply that's coming into the market, if you're in a market that is like in Austin or parts of Florida or the Sun Belt where they build a lot of homes, and then you go into an environment where there's this really big affordability squeeze, well, the builders will do affordability adjustments to try to meet the market, right? They're going to want to continue to move that supply. And definitely they're going to try to move uncompleted, unsold spec inventory, right? That's where they'll be the most aggressive on their incentives. And so these builders have done things like these bigger mortgage rate buydowns. You look at a Lennar that's spending 13.3% of average final sales price on incentives. So on a $400,000 house, they're pretty much ponying up like $53,000 on incentives and mortgage rate buydowns. And in a normal market, Lennar would do 5-6%. And at the height of the pandemic housing boom, they were doing 1.5% sales incentives rate. That really speaks to how much that market shifted. And so when you have the builders like a Lennar doing these huge mortgage rate buydowns, or you have a builder like a KB Homes doing some outright price cuts in the markets where they need to move inventory, then what happens is some of the buyers who would have went to the existing and resale market, they're like, well, these existing and resale market sellers are naive. they're not coming to reality. But this builder, he's going to work with me, right? And so some of the buyers who would have otherwise went to the resale market are going to new construction. And so then that resale and existing inventory gets additional upward pressure and builds more. And you get that more of that month's of supply. And then eventually does force some of the sellers who need to, to sell, who are, they have to sell, right? They're motivated sellers. Then they'll come down on their price if they have to, if the market reality has moved there. And then you look at the multifamily side, and some people are probably like, well, Lance, how does multifamily supply have anything to do with home prices or for single family prices? And well, it comes down to this. Right now, the buy rent math is really messed up, right? And we are at a really big historical deviation between what somebody would pay for rent and what somebody would pay on their monthly mortgage payment if they bought today. And so with this multifamily supply coming into the market, some of these developers who need to move it, they're doing outright rent cuts in some of these markets that have this bigger supply, right? They're doing an extra month or two of free rent, different incentives to kind of get people on board. And if you go through the markets that are really in a pinch there, like in Austin, the incentives are or even greater than what I'm talking about here, right? And their occupancy, they have some real issues with some of their occupancy and some of those markets for the new supply. And so it's not just a normal level of multifamily supply that's been hitting the market. During the period of ultra low rates, a lot of money poured in, a lot of institutional capital as well, into multifamily, right? Into multifamily development. And that it takes a long time once the project is financed and approved to go all the way to completion. And so in 2023 and 2024, we were still feeling a lot of the multifamily supply that was financed back in late 2020, 2021, early 2022. And so 2024 saw the most multifamily supply since 1974 when Richard Nixon was still president. Now, we have seen that begin to roll over, and we are seeing, and for the starts for multifamily has been down for a bit, and now so multifamily is finally starting to roll over as well, which does create some additional cooling for the economy. But going back to housing, so that additional multifamily supply, if you look at the correlation between it and where prices have fallen the most, there's a very strong correlation there.
Hey guys, I hope you're enjoying the show so far. I just wanted to take a brief minute and share some exciting news. I have just released my new Todd Simple home buying course. This course is designed for anyone wanting to know how to buy a home. It's designed to take you through the entire home buying process from start to finish. You'll learn how to represent yourself should you want to avoid paying real estate commissions, the best ways to shop for a home, how to avoid costly mistakes, what to look for when touring a home, negotiation tactics, and so much more. In this home buying course, I hold nothing back. In fact, I would go to say that no one has uncovered the home buying process like I have. I've even made a way for you to gift this course to your family and friends. Visit saxrealty.education. The link is also pinned in the comments below. Now back to the show. Interesting. Yeah. The home buyers are renting because, like you said, it's so much cheaper to rent. And I just want to kind of backtrack a little bit on some of the things that you said. As we were witnessing the pandemic boom and the price appreciation, where home values in a lot of markets doubled, and sometimes, in some cases, even more than that, they were setting new comparables. So the market was outpacing valuations. But the way that people were dealing with that is they were getting gift money from mom and dad, and they were putting large chunks down. So in a lot of cases, they were raising in one transaction the home valuation of 12 or 15% just by overbidding what was normal, a normal comparison for that house. And you were talking about short-term rental. What we've seen in the brokerage side is over the last many years, about a third of the home buyers have been investors, whether it's mom and pop or institutional investors, or now this short-term rental phenomenon, which was, by the way, fueled by the 2020 pandemic boom. These types of investors for short-term rentals were people that had money, and they were buying these second homes to profit, and they were looking at big returns, so they could actually pay more, which is odd because typically an investor for a long-term rental or a flipper, they need to pay much less than an owner occupant would pay in order for it to make sense on a rental side. But this new birth of this explosion of short-term rentals where they could actually, pay more for the short-term rental because they were renting that house by the day or by the weekend or by the week. So it was much more profitable. So that was competing. All of those buyers were competing and causing this fiery demand, just like you're describing.
And to go back to it though, too, it's like, well, we had seen late 2020, we were already booming, right? And for housing. And there was definitely a pretty big disconnect from what was happening in the reality of housing and what the central bank was doing.
Yeah,
And
of
so
course.
2021, even as things continued to go crazy, the Fed is still buying boatloads of mortgage-backed securities. And so how
And dropping rates.
how that market works for long-term yields is it's really the supply and demand of the bond market, right? And so if there and bonds move inversely to yields. And so if there's more demand for mortgage-backed securities, and the Fed's buying up a lot of mortgage-backed securities, the price of mortgage-backed securities goes higher, but the yields go lower, and so mortgage rates go lower. So when you buy a lot of mortgage-backed securities, it puts additional downward pressure on the yields for those and the mortgage rates, the average 30-year fixed. And so we have so much of that housing demand in the market, and the Fed is just still gobbling up those mortgage-backed securities in 2021, and we're at, ultra low, historic 100-year low for long yields like that. And so, it was incredible to kind of see and watch, especially if you were anywhere close to housing, and then to see how the Fed was viewing the economy. There was just a huge disconnect. And it accelerated the amount of housing demand, and it kept a lot of that demand in the market. And for the investors, I can understand why they were out in the market buying when the rates are so low and rents are ripping and home prices are ripping. But you would think somebody at the central bank would have put two and two together.
Yeah. Well, I mean, if you think about it, it did the accelerated rate of home values brought in a lot more accelerated increases to property taxes. So, I mean, revenues certainly, and I mean, look, I look at our industry. If you're making a certain percentage on a transaction, you agreed with your client that you're getting paid a certain percent, and now all of a sudden that house price has doubled. I saw very few people, if any, actually thinking about it, that said, "Hey, I'll chop my rate because of the house doubling in value and the same amount of work's involved." And there'll be real estate agents that will argue with me on that, saying, well, they had to write 25 offers, but most of them didn't even look at the houses. I mean, basically, you had an open house. It was standing room only. It caused traffic jams in residential neighborhoods where no traffic would go through in the course of a day. They have an open house. All of a sudden, it's a traffic jam. You felt like you were going to a rock concert or something. And then you get there, there's a line to get in the door. And then all of a sudden, if you had the listing, an agent would call you up and say, oh, yeah, my client came by the open house and they want to put an offer in. Well, did you see it? No. So, for the agents out there that say that they worked harder during the pandemic boom, I would argue that maybe their fingers worked harder doing multiple contracts. What, Lance, I mean, obviously, you talk to home builders. Some and I do want to get into inventory because following you and your data, inventory still appears to be rising. Is that what you're seeing?
So what we've been seeing is that on a year-over-year basis, active inventory is still rising. You are going to see some headlines about inventory being down in the second half of the year here in a lot of markets. And the reason for that is not necessarily a tightening of the housing market. And so what I mean there is that a good amount of what we are seeing in the inventory drop is not because demand is rushing in and absorbing the homes for sale, which is I've heard that as a narrative that mortgage rates coming down the past few months is why inventory has come down. Uh, I look at the data, and what the data tells us is that there's been a spike in delistings, and so what that means is that there's a good number of sellers who can't find a buyer at the price that they're trying to sell the home for, or they've cut the price several times through the spring and they're still not finding the market. And so they're pulling it off. And so we've seen a spike in delistings. And if you go back to the past couple of years, what we have seen is the markets that have seen the greatest spike in those delistings and the pullback, greater pullbacks in the active inventory in the second half of the year have been some of the markets that next year saw actually a greater softening again still.
Mm.
And so an example of that is Austin. Austin's metro area, the past couple years, if you look at the active inventory, has seen a pretty big pullback in the seasonally soft period. A pullback in the active listings, and what it is it's really just the delistings have spiked up, right? And so, in my view, that pullback in that active inventory is not necessarily this bull signal of tightening that some people think it is. Now, on the other side of it, it's also a signal that this isn't necessarily a 2007 type weakening, right? Where that active inventory is just going parabolic. There's more of a fight, like sellers are putting up at least a little bit of a fight. And so if you're a seller and you listed in April and you cut your price 10, 15, 20K, then 30, 40K, and you didn't find, a buyer there, right? And if you're in Southwest Florida, or one of these markets that is rolled over more, and then you pull your home off the market and your plan is to come back next spring and list it, that's kind of different than a forced seller in, let's say, 2007, 2008, where they have to sell and they're going until they sell it, right? And so there's a bit more of a resistance to the fight, but it's not the tightening that the bulls think it is.
A lot of the, and I'm glad you brought that up. That's a really good point. And um, a lot of the resistance that we're seeing from sellers is because they're not seeing distressed sellers changing the market like they did in '07, '08, '09, where if you're going through a foreclosure, it doesn't mean that all foreclosures are in a distressed state. It doesn't mean that your house is trashed. Now, it could mean that, but when people were going through financial distress and they were wanting to sell their house, there were a lot more comparables that of lower price because they were panic selling because they had to get out from under it. We see a complete different shift in that because they have prevented foreclosures from happening for so long. I mean, we remodified over 1 million households. I don't even know what that total is right now, but that is one of the reasons why the neighbors aren't saying, well, or the sellers aren't saying, well, my neighbor had to sell for 50,000 less or 100,000 less or 150,000 less. But we are starting to see where at least even in our market here, and me talking to other brokers, there are being new comparables, lower comparables that are being set. It's just trickling down at a much slower rate than what we saw before, which kind of brings me back to where I was headed is you deal with a lot of home builders. You talk to them. You're fortunate. You get a lot of information that we don't get, even as real estate brokers. They're not talking to us. They're actually masking a lot of the information from us because they want us to just bring our clients in, obviously, for obvious reasons. They want us to direct our buyers to buy their houses. But there's some whether they're anomalies or whether, I mean, some people, or whether they have inside information. I don't know. But you see like Warren Buffett investing a whole lot of money in home builders. And now we're starting to hear where, from our president that he may declare a housing emergency. I'm not trying to put those two together, but I'm just saying that we're hearing all of these things. It seems disconnected for me because I'm watching inventory levels rise while people are saying we need more housing. That is kind of strange to me. I'm hearing that we need to drop mortgage rates when new home builders are offering, some of them 4%, 3.99% for 30-year fixed rate mortgages, and that's not moving the inventory. So maybe you can clear some of this up. What the heck is going on between what your data is providing us and you're watching this stuff and what we're being told that we need to have happen to fix the housing market?
Yeah. So let's start with the Warren Buffett part. So back in August 2023, so we had went through the mortgage rate shock in 22. The market had kind of really destabilized in the second half, then kind of tightened up a bit. Warren Buffett disclosed that in Q2 2023, the company had bought into home builders like D.R. Horton, Lennar, and NVR, which are three of the largest home builders in the US. But then only a few months later, in February 2024, Berkshire Hathaway disclosed that in Q4 2023, just 6 months later, they had sold off almost all of that bet. And so, that abrupt buy and sell raised eyebrows because, Buffett famously wrote in his 1996 letter to shareholders, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. And so it was kind of like, why would Buffett and Berkshire Hathaway buy builders early 23 and then sell them off in the second half? And what we have seen since then is that home builder stocks did pull back significantly at later part of last year into this year as Wall Street analysts really began to price in more margin compression. They believe that, where the market was softening and what was occurring was going to cause the builders to have to do bigger outright affordability adjustments or outright price cuts to kind of move that product, and where that would take a hit is the gross margin. Now, heading forward now, we have seen that home builder stocks have kind of ticked up a bit from their lows, and we have seen that Buffett now has bought back into builders. And so why would Buffett do that? And it could be a few different things. One is that a lot of these analysts buy the builder stocks and sell them based on their view of long-term yields, right? So it can be a bit of a play on long-term yields, and maybe they think long-term yields are coming down a bit. The second part is that Buffett and Berkshire Hathaway might just have a really long view of housing, right? They might look at this period and, see that builders have already come down. If you go back a few months, back when they bought these stocks, were down 40, 50% from their peaks, right? And so they might have been like, you know what? Yeah, we understand that there's going to be some pain here in the housing market this year, maybe even next year. And maybe, there is a greater give up in price and net margins, but maybe we're looking out 10 years, right? Maybe this is a long play and the builders are off their peaks 30, 40, 50%. And so maybe that's why they bought. But again, this is all speculation because Buffett and Berkshire Hathaway, they didn't come out and say why, right? Now people are, everybody's running with that and kind of putting it into their own narrative. But at the end of the day, we're all assuming, right? And even a lot of what I gave you is there's some assuming going on there as well.
Trump maybe this fall declaring, Bessent has been saying this, a housing emergency. What would you expect that could be done, and would that work?
Well, so we're in an interesting moment where, there's talk about like, what can we do to increase supply, right? And then at the other side, in the market, we have a lot of builders with their unsold spec inventory that they can't move. And they're actually, according to Toll Brothers CEO, that, I gave you that transcript several months ago from that private event that I got to go to in June, the Bank of America's Housing Symposium. He's saying that they're actually pulling back on spec. They're pulling way back on spec in a lot of these markets. And so there's a little bit of a disconnect at the moment in the short term about what policymakers are talking about and what's kind of happening on the ground in the housing market. But in terms of, you know, this whole thing, whether you're Republican or Democrat, I think it's probably smart politically to talk about this issue, to talk about housing affordability and to talk about affordability in general, because right now in just society at large, there's this really big squeeze happening in housing and it's happening in autos and it's been happening for 3 years. Because during the pandemic period, we saw a big overheating for home prices and we saw a big overheating for auto prices, for prices. And then that was followed for both of those by an interest rate shock. And so to go out and buy a home or to buy a car, which these are big monthly expenses for people, the price to do so, that switching cost is astronomically higher than what people are used to. And so society at large right now, there's this really big affordability squeeze that's happening for housing and it's happening for autos. And you could also throw in credit cards there as well, where those interest rates have really spiked. And so, a certain segment of the population that is more exposed to that, they've been feeling a greater squeeze there as well. So politically, it makes a lot of sense, regardless of the party they're in, to talk about housing affordability. And so you're seeing it on a national level with the Trump administration, and you're seeing it on a local level with Democrats in some of these states as well as Republicans talking about housing. And you're seeing it also not just being framed as through the lens of the purchasing market, but you're seeing it framed through the lens of the homeowners, because you're seeing a lot of these states now, whether it's Ron DeSantis in Florida or you have Vivek Ramaswamy running for governor in Ohio, talking about abolishing or really pulling back on property taxes. And what's going on there for property taxes, and you were ahead of the curve on this, is that you see a big overheating for home prices, and that's followed by an echo overheating for property taxes. And so the homeowners who kind of, watched, their paper net worth rise a lot when the prices overheated and maybe even got to refinance to those lower rates, on the back end now, they're feeling the squeeze of the higher carrying cost from the property taxes, from the home insurance that has been hitting the past couple years. That's all really just an echo of that overheating for prices that we saw late 2020, 21, early 2022. And so I think you're going to continue to see politicians talking a lot about housing just because of how squeezed people are. Now, that's why they're doing it. Now, what impact does that actually have? Well, my view of housing is that it's going to take time for the market to continue to go through this recalibration period, because you had that big pull ahead in housing demand and we're really just smoothing that out, right? And as prices, either flatline in more of these markets or see outright declines, and then you continue to see incomes rise a bit, you're slowly improving that math. The current trajectory it's going to take a long time. If this is the trajectory we're on, it's going to take a long time to heal this housing affordability. And so I think time is a key component. And so the things that politicians are going to try to do, I'm a little skeptical. And I've been skeptical not just of what Republicans have put forward, but also a lot of Democrats as well. It's just not necessarily how housing works. And we have to be attentive to, there's a housing cycle at play as well.
Yeah, and it didn't work in 2007 when they dropped rates. We're looking at housing for the most part that's still priced at 2.75% for a mortgage rate. And even if they get close to 5%, which would be huge, I don't think anybody's predicting that even. That's still not going to do it because, like you said, I mean, all of these other costs and the cost of ownership have gone up. I mean, just repair costs. My gosh, a house falls apart around us if we don't keep it up. So just to call a contractor and do the smallest repair or replacement is costing thousands of dollars to do. So, which is a shock all in itself. When you say time, I mean, nobody has a crystal ball, but you think that because of, I mean, when you look at housing, you've said a lot here today, uh, an oversupply of multifamily. We were in that cycle because it takes a couple years to actually build this out. You figure it can take 6 months to build a house. Try building 120 units or whatever on a site. It takes years to do, 3-5 years to build these sites out. It's getting absorbed, but that's because people are renting, not buying. So we are seeing that multifamily housing be absorbed, but at a cheaper rate by giving the 2-3 extra months to convince somebody to sign a lease. You see home prices, regardless of what they're doing, continuing this downward trajectory?
I think on a real basis, at a minimum, right? And that so there's different levers that can be pulled here. Of course, if you know it if it, as long as we continue to have incomes outpacing house prices, we can see the affordability improve in terms of the affordability metrics. Now, if a market is seeing outright declines like Austin is down 23% from peak, and incomes in Austin have continued to rise. So Austin has gone from, according to Moody's analysis, being overvalued around 70% to now it's only overvalued by 15-20%. And it's kind of getting really close back to its historic equilibrium, right? And so if some of these markets see outright declines, that can accelerate the healing in that market. And that's what we've seen in an Austin, and we're seeing it in some of the other pockets of the country. But the truth is with housing, if you go through the history of it, you some when you've seen these periods, some of the ways that markets have gotten back to their equilibriums have been through either leaning way more on one lever, maybe it's the income or actual outright house prices falling, or it could be more of the other lever where it's just a really long time of incomes outpacing house prices to kind of create that healing. And so I don't think there's a guaranteed roadmap where I can say that in X years we'll be at X affordability and X will have come because of this. But I do have the thing that I'm more confident on personally is that we are in a period where housing affordability is healing. We are seeing a recalibration. And I think that in 2025, we'll see a healing for affordability. And I think that the current trajectory looks like 2026 as well. But the current trajectory that we're on is more of a grind to get there at the moment.
Well, you describe places like Austin that have seen 23-24% price declines from their peak. And there are a lot of people that bought at those peaks. And also with Moody's saying that maybe they're getting close, but maybe another 10 or 15%, which really pushes us to 40% price declines from peak in cities like Austin. How is that affecting buyers that bought at the peak and their mortgage and their ability to ever sell their house?
Well, one thing I should point out is that, even if some of these metrics have Austin still 10-15% above their normal equilibrium, that doesn't guarantee that we're going back to that equilibrium. And it also,
but even at 23 or 24%,
but also, it also doesn't guarantee that if we did get to the equilibrium, that it doesn't go below the equilibrium, because markets can also, see that overcorrection as well, right? On the other side. So I just wanted to kind of point that out. But so the people who bought at the peak in Austin, their saving grace here is that Austin had went up so fast for prices, at one point 40% up year over year. And so they were up 70% on a metro level during the pandemic housing boom. But because they had went up so fast, and then when 2022 occurred and that net domestic migration pulled back, the mortgage rate shock occurred, the market was really over its skis, builders kind of knew it, and a lot of builders quickly cut 10, 20% really fast. The market kind of blew off its top quickly. And so the actual cohort that would be down 20, 25% from peak is it is a smaller group. It's that very end of that 2022 group. So that's their saving grace, is that even today with prices down 23% in Austin, only 4% of the homes in the metro are underwater. Now, so that's the good news. The bad news, potentially the risk, right, in the market is that because we have been now in so many of these markets kind of close to a similar price for the past 3 years, if we were to see a bigger blow off in more of the markets now, the actual number of people who would be underwater would be far greater. So if some of these markets today saw the 23% drop that Austin has, those markets would have a lot more people underwater because they aren't like Austin, where Austin just had that top of 2022. A lot of these markets have been at a similar price for 3 years. That's a tremendous amount of, even at a suppressed levels of transactions, that's still a lot of people transacting in those markets. So so for Austin, it's not a huge issue at the moment, but if other markets were to go through the healing process that Austin has, it would become a much bigger issue for what you're pointing out in those markets. And then the other thing I'd like to point out here is that when KB Home's CEO was speaking, uh, or COO was speaking on an earnings call back in June, he pointed out the risk for some of the buyers who might be overpaying to get those mortgage rate buy downs. So if they're taking that mortgage rate buy down, right, and they're buying at, let's say, 600,000, but really the house is maybe worth 540, they could potentially be in a position where if they tried to sell because they don't also, they're not also ponying up for that mortgage rate buy down for the next buyer, and and that next buyer can't assume their mortgage, that they could from out of the gate be underwater and be underwater by more than they know. And so the COO of KB Homes didn't exactly put it that's not an exact quote, but that was his gist of what he was kind of telling buyers to keep in mind, that if you're going out in the market and you're potentially overpaying for these bigger incentives, that there could be risk if you have to sell in the short term. And I think that, in this market, I think that this is kind of a challenging market for people who want to buy and only plan to stay in a house for a few years, right? Or a shorter period of time. If you're somebody who's going to be buying in this market, it's definitely better to have, in my opinion, a longer horizon, because you can spread out more of that downside risk if you're planning to buy for a really long period of time. And if you're out in this market shopping in some of these markets, you have the ability potentially to find deals, to negotiate, and maybe go out, and if the market's X, you might be the person who's able to pull it down to Y, right? And so and that all varies regionally and by neighborhood, but just something I wanted to point out to keep in mind if you're out there shopping for new construction, to kind of, to be thinking about maybe what KB Home COO had said. And, if you're also out there, see what you can negotiate. Try to see if you can use some of that leverage in some of these markets where inventories build up. And I'm not trying to push anyone any which way. I'm just saying things to keep in mind. Because one of the things that I've tried to do with my coverage, and this has been true back to my time at Fortune, is I'm not trying to push anyone any which way. I'm just trying to, here's the information. I'm going to go out and I'm going to research on housing, and I'm going to try to find the highest quality information that I can and put that in front of you.
That's why we have you on the show. Yeah, we value what you're doing. Any insight to the Northeast? I hear a lot of people that are saying, when will affordability return to the Northeast? Are you seeing now that some of those states are correcting?
What we're starting to see in more of the Northeast markets is still more of a fight up on active listings. We are seeing active listings rise, but they're still at much lower levels than a lot of the country. But on the price side, we've seen a lot more of the markets in the Northeast go from either elevated price growth or slightly, slight price growth to really kind of flatlining with their price growth. Now, we are starting to see in pockets, and I could actually just show the data. This is a dot representing around 30,000 zip codes in the United States. And what you can see, of course, is that a lot more of the softness is in the bottom half of the country. In the Sun Belt, a lot of the markets in the Sun Belt, and more of the West Coast, especially around the San Francisco area. But you are starting to see more of that yellow, which is zero, and some of that red even pop into some of the places in the Northeast. The greatest area of weakness in the Northeast is Vermont right now. And I think what you're probably seeing there, and I was kind of looking through some of the data, because you have seen a bit of a pullback in terms of the Airbnb buyers and the investor buyers and the second home buyers. I think that that's some of what's going on, right? You might have some of the people who bought up there in 2021, and then they're kind of finding out, maybe they lost their job or their company is kind of not giving anybody raises who's not in the office, and they're kind of starting to fall behind on their career. And they're like, you know what? Maybe this huge change that I thought was coming to the economy and the world and everybody was going to be remote, maybe that's not where things are. And they're kind of getting pulled back to some of these markets like a Boston or a New York City. I think that that could be at play. But still, the greatest level of tightness in the housing market, it can be found on a relative basis in the Northeast and the Midwest. But it's slowly changing. We're starting to see some changes, and you're starting to see some pockets here and there where that change is happening more so. But Kentucky, Indiana, parts of Ohio, some of these areas of Wisconsin, some of those people are probably reading, some of the stuff that I might be saying about some of these builders or the Sun Belt, and they're like, "What are you talking about, Lance? I'm not really seeing that here." But one thing I can tell you in the data is that those markets did, in a lot of those areas, have a far lower level of overvaluation in 2022. Just like I showed you earlier in my presentation today, where a lot of those pockets of Connecticut and New Jersey were far lower then. So that's one thing. But I should point out number two, which is lately, the past 3 years, we have seen those markets become more overvalued, which is kind of interesting. So a place like a Connecticut and some of these places in some of the pockets of the Northeast and Midwest that were very low overvaluation in Q2 2022 relative to their peers in the Sun Belt, they've now started to creep up because some of these places, like in Connecticut, they still saw prices go up 7-10% 2023 and then 2024, while rates were still this high. And yes, incomes rose in that period, but they weren't rising 7-10%. And so I think that that's one thing to keep in mind heading forward.
Well, you had a lot of cash buyers and a lot of people with money that live in Connecticut. I mean, it's a very wealthy state. And I think, that's something else to keep in mind. A lot of people were moving from the north and the Northeast going south and buying places during the pandemic. And like for all the reasons that you mentioned, I mean, they could work remotely and run their businesses and their staff was at home.
Let me jump back to that point, which is
Yeah.
when you hear the lock-in effect, you hear the word lock-in effect. What I view the lock-in effect as, and I view it as a real thing, is that essentially affordability has created this really big squeeze for a certain group of homeowners who would like to sell and would have liked to buy something else, that natural level of churn that happens in housing. But either they're looking at what that new monthly payment would be and they're like, I can't stomach that. I can't afford that. Or they literally would not be mortgage eligible given their income to take on that higher mortgage rate. I mean, there's a huge chunk of homeowners that at today's prices and today's rates, they could not have bought their house at their current income today. And so that lock in effect has kind of pulled a chunk of the churn out of the market. And that's why not active listings, but for new listings, it's still suppressed in a lot of the markets. But that lock in effect, if you think about it, it creates a shock to supply, but it also creates a shock to demand because it pulls away one seller and it pulls away one buyer, right? If you're not selling your house to buy something else, that's one less seller and it's one less buyer. But that shock to the supply and the shock to the demand can occur in two different places. So if you're somebody in New Jersey or Connecticut or Illinois, and you are going to sell your house to buy something in Arizona, Florida, or Texas, but you're like, you know what? Where rates have gotten to, where prices have gotten to, it's really I'm no longer as financially incentive to run away from this higher property tax state or this higher income tax state to go to those places. And so they don't sell. Well, that creates one less home for sale in a Connecticut or an Illinois or a New Jersey, but it takes away one buyer in Arizona, Texas, or Florida. And I think that that element is quietly played a little bit of a role in the current bifurcation that we've seen in the market.
Interesting. Well, Lance Lambert, we always appreciate having you on, and we look forward to next month's update. And anybody that wants to follow you, just kind of tell us speak to Resiclub. What's the best way for people other than signing up for your emails? I mean, obviously, what are you putting out there now?
Yeah. So if people want to follow along to my work, they could go to resiclubanalytics.com, put in their email, sign up for my newsletter. I do a free one where some people get a few issues a week. And then I also have, if you're, kind of somebody who is going to be following housing for a long time, maybe you work in the space, maybe you're an agent, builder, developer, and you need to really know what's going on and get a more independent view that's not necessarily NAR, not necessarily Redfin or Zillow, and you want a more independent view of the housing market, I have a thing called Resiclub Pro, where I send out 3 additional research reports or research articles per week, get really deep into the data, give you access to a lot more of my spreadsheets. And I have another tool that I'm about to roll out in the next few weeks, and maybe I'll come on and talk about that as well. And then people can follow me on LinkedIn, Twitter. I'm always posting charts and trying to figure out what's going on in the housing market.
Awesome. What's going on with your New York thing, man? I felt like I missed something here. What are you doing in New York City? You're having these this one-day event where industry leaders are coming to talk about that.
Yeah. So on Friday, November 7th in New York City, I'm having an event called Resi Day. I did it last year. I booked the venue in around this time last year, mid-September, had 183 people come out. Pretty good turnout for a quick turnaround. This year we already have around 160 registered, and we still have 2 more months to sell tickets, register people. I think we're going to have 300-400 people potentially at Resi Day, and it's kind of leaders and across the housing sector, builders, developers, investors, agents, a lot of people who kind of are in the space, but want to kind of know, where does housing head in 26, 27, 28? Where are the risks? Where are, potentially areas of opportunity? And where does kind of the industry head from here? And then also to kind of discuss, what are the things that could be done and, to help housing affordability. How do we get there? And so we have some different builders and entrepreneurs who are kind of coming up with different creative things. We'll have Rome CEO. He has a platform where people can go on and they can find themselves of the homes for sale in the market. which ones actually have an assumable mortgage, right? Because those FHFA,
There
those
you go.
VA mortgages, they can be assumed, right? If people meet the different guidelines that go with it. And so they take like a lot of the listings that are on Zillow and they say if they have that assumable mortgage.
Are
And
they doing that right now? Is
right
that
now,
launched
right now, yes,
right now? What's it called?
Rome, ROAM. And so you can go on their site and they were at like 4 states and now they're up to like I think 9 or 12 states. And they also help buyers through the process where because a lot of agents and even a
Smart.
lot of loan officers don't really understand the process for assumptions because there's only 6,000-7,000 that get done per year, but it can be a huge monthly payment savings. And if you go back to 2023, a lot of sellers they didn't wanna deal with the assumption process because it takes longer, right? But in this market today,
Yeah, they'll wait.
buyers have a lot more leverage, and so some sellers are more willing to go through this process, and a company like Rome, they take, like, a 1% fee. So I have different companies across the sector who are trying to do some of the things to kinda unlock housing. Now, of course, individual companies, that's those are things that only will really improve it on an on the edges, right? But that's kind of the discussion that we're gonna have is just this, independent group, Resiclub. We're a news and research outlet, and we wanna bring together, different leaders across the sector to talk about where the housing market's headed for here from.
If somebody's listening and wants to come to this event, feels that this is the place for them, they're in the industry, how can they find out or register for it?
Yeah, they could Google Resi Day 2025, and they'll find this Luma page where they can find a bunch of details. They can also send me an email, lance@resiclubanalytics.com. And if they want to talk to me, they could even reach out to me and I'd be willing to talk to them and try to see if it kind of matches for them. Are they going to actually get value out of it? But I plan to do it every year. And so last year was the first, and hopefully each year it grows.
It's awesome. Well, Lance, we'll take all of those links as well and dump them in the show notes for all of you to follow along. And again, thank you so much for coming on, and we'll see you next month.
Thank you for having me.
Thanks so much for watching. If you liked the video, you can let us know by smashing that thumbs up. And if you haven't already subscribed to our channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. Keep those comments and questions coming. And one of the biggest compliments you can do for us all here at Sachs Realty is to share our channel and this video with your family and friends. This will help us to continue to build this amazing online community with viewers just like yourself. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.